What's going on, everybody? Lawrence from financialthing.com. It is the Tuesday evening stocks. Let me change that camera angle a little bit. Stocks and cryptocurrency live stream. Doing something a little bit different this evening, and I have a special guest here. His name is Joseph Hogue. He is a Chartered Financial Advisor, which is, I think, the first time that we've ever had anybody like that on the channel. You know, I've talked a lot about financial advisors and some of the bad experiences, some of the reasons why you might want to use one. So I figured Joseph had reached out to me, and I thought, let's get him on the stream and see what he has to say about investing and what he's up to, his background, the world of cryptocurrency. I'm just going to bring up the chat live, as you told me I should do in the past. So I can see what you guys are saying. Here we go. Oh, turn that down. But yeah, I hope you guys are all doing really well. We'll be back on Thursday with Philip from Landlord Invest Live here too for the Q&A interview. So we'll have a chat with him. And let's get right into it. If you have any questions for Joseph, just go ahead and put it in the chat and we'll ask him as we go along. So just give me a second. I'll go ahead and bring him in. All right. So Joseph is here live. Let me bring him on right here. Here he is, the man himself.
Hey, Lawrence.
Joseph Hogue. Say hi to the audience out there.
Hey, audience out there.
You're missing your bow tie today, I noticed.
I am, trying to kind of keep a relaxed atmosphere here today.
Now, Joseph has a website. I'll just show you that real quick on stream. It is mystockmarketbasics.com, and there's a link down below in the description if you want to go check that out. And he also has a YouTube channel called Let's Talk Money with Joseph Hogue, CFA, Chartered Financial Advisor. So go subscribe to his channel, give him a subscribe, and hit that bell notification, please. If you can do that, I'm sure he would really appreciate that. So thank you again for being here, Joseph. Let's talk a little bit about your background, and particularly interested. You are the first financial advisor that's ever been on this channel, and I'll admit I've been a little bit hard on financial advisors in the past.
Well, I hate to disappoint you, but you might not have a financial advisor yet. It's a chartered financial analyst.
Chartered
so
financial
there
analyst.
is a difference. I think you might be thinking of CFP, so certified financial planner is the advisor designation. CFA is more of an equity analyst.
So, okay, yeah. That's the designation. Okay, so my mistake.
CFAs mostly work on Wall Street for the big banks, analyzing stocks, asset classes, things like that. The CFPs, those are more the Main Street advisors that most people are a little bit more familiar with.
Okay, and that's awesome because I usually make one big mistake during the stream, so we got that out of the way early. I'm known for doing that. So that's even more interesting to me that you're an actual analyst, and because I think we can get more into the depths of investing. And people on the stream love that. So sure. Tell me, what's your financial... Oh, first of all, tell us where you were actually speaking from.
Actually, from Medellin, Colombia. So came down here originally from Des Moines, Iowa. Good old bread and butter there. Served in the military, in the Marine Corps for several years, and then did a lot of work experience there in the U.S. But eventually, actually came down here for free trade consulting around the free trade agreement with the U.S. and Colombia. There in 2006, did some consulting, loved it. Cost of living is next to nothing, large city, that kind of thing. So ended up staying. Mm-hmm. And really, working remotely using that geographic arbitrage, as they say.
Do you love it down there?
It's very nice. Large city, low cost of living. There are things you miss from the U.S., the conveniences, obviously. So we're actually getting ready to move back up to the U.S. to Tampa here sometime this year. But it's it's something I recommend to everyone, especially if you're building a business or an online business, something like that, or a side hustle, anything where you need time to really grow that business and the cash flows, and you can't do it from the U.S. where your cost of living would be so much higher. So
Yeah.
go on down to a foreign country or wherever it may be, lower cost of living, give you that time to build that business, and then you can pretty much write your own ticket.
Okay, that's cool. And I always love to pick the brains of people who are interested in investing. So I have to ask you, what was the very first investment that you ever made when it came to, like stocks or something similar to that? The very first
Sure.
one.
A very first one would have to be I'm 8 years old. My mom works at a company called Comtron. They're in Des Moines. It's a small it was a small electronics company, very small actually. And we invested in shares of that. I think I put maybe $80 to it. Of course, being all of 8 years old, put $80 in it. We actually made about 22%. This was early in this mid 80s. And so the company was just coming up. Sold out at 24%. I think it went much higher after that, so we kind of sold out too early, but it was a good experience.
That's the difficulties of market timing that we always talk about on this channel. Is it's impossible to get it right. Is that company still in business today?
No, I think they got bought out, got acquired, probably in the 90s there, in the the tech boom.
Yeah, that's one of the problems. Like when you invest in single companies like that, you just don't quite know what's going to happen long term. They have that
Sure.
possibility of going bust or getting bought out, which is a good thing. So I have to ask you, you have obviously been investing for a long time. What was the best investment that you ever made?
Best investment probably by far would be Netflix. I was able to get in right around 2012, so a couple years after the IPO there. But get in 2012 after the crash there. Got about $9 a share, maybe a little bit higher, and then sold in 2017 for just under $200 a share. So again, sold a little bit early. Didn't get a lot of the last few years, the big run up there, but it was something like 200 about 20 times, right? 20 times the return is pretty darn good for less than a decade. So I'll take that any day of the week, right?
Did you have that emotional, difficult decision as to whether you wanted to hang on long term? Because I think that's something investors struggle with, whether, when is that right time to get out of an investment?
Sure. Well, after anything makes you so much money on that, it's you almost create some kind of an emotional attachment to it. I think a lot of times the company. So I think that's one thing that investors have to struggle with, and you really just have to separate yourself from the company, from the investment. I see a lot of that happening with the meme stocks over the last few years. Tesla is another good example, and not that they're not good companies. Tesla is a great company. It's revolutionized driving. But I see too many investors just get emotional about the company, about the founder, the Elon Musk, and all that, and it kind of blinds them to what's happening at the company, whether it's good or bad, and they really cease to be able to look at it dispassionately and as an analyst and look at the company because they get so emotional about it. So yeah, that's one hurdle I think for a lot of investors. Of course, the other one is holding on to a stock that is losing money, and that fear of actually making it a real loss rather than just a paper loss, which is the other end of the spectrum that I think a lot of investors struggle with as well.
Yeah. So you're probably not familiar with this channel, but we've been doing this series for I think since 2020, if I'm not wrong, but it was where I took a portfolio of my own money, invested it into stocks, and I had a couple of stocks in there that were real dogs, that we were in the negative so much, and it was so painful to exit those positions when you're seeing it in the red of 55, 60%. But I tell you, when I did do it, it felt actually really good. I was like, I'm tired of looking at this stock that's just done poorly for the last 2 years, so let's get rid of it. And then on the other side of that, I think I had this Apple stock that I've owned for a long time, years and years. And I was looking what's going on in the tech industry as far as in the markets right now. Tech is just getting hammered. And I found it really difficult to pull the trigger on ejecting out of that Apple stock just because it's a stock that I've had for probably, 6, 7, 8 years.
Sure.
You bring up a really good point. So on the other side of that, Joseph, What was the worst investment? Because we all know we've had winners and losers, right? Does that one stand out to you?
So many losers. I'd have to say Peabody Energy, which is a coal miner in the U.S. here, ticker BTU.
BTU.
It was 2012. The coal miners were really struggling across the whole industry, really. But you look at it, and it was still something like 42% of electricity generation was produced by coal. It was Peabody was really the market share leader, and had strong fundamentals other than that. So I looked at it as kind of a best in class, best of breed in an industry that was just temporarily struggling, and just kept on investing it all the way down to the bottom. And of course, they eventually filed bankruptcy, which I think is a great lesson for investors that you really have to be on top of the fundamentals of a company and their debt, how much cash generation they're able to do, and whether they're just able to survive, with their debt load. A company can't. A lot of people say, well, Peabody will always have a Peabody Energy, right? Or we'll always have a, some of these others, like, the airlines are great examples because they, perennially file bankruptcy. But people will say, well, we'll always have an American Airlines. We'll always have a Delta, right? So I'll invest in that at these really low prices when they come around. The problem is, we may always have an American Airlines, but they love to file bankruptcy and wipe out all those investors, and basically that just sets it back to zero for the investors. So it doesn't. It's got to be more than just a strong company. It's got to be one that can survive through even temporary hard times.
That's so funny you mentioned BTU, because that was a trade that I made personally about a month ago, and it was probably one of my poorest trades. I didn't go through that bankruptcy period, but it's so funny you mentioned that one stock, because that was one of the 5 or 6 stocks that we were holding in the portfolio that we were focusing on the channel that kind of really stung. I think it went down like 25% the day after I bought it, so that wasn't a good one. So I'm glad to hear I'm not the only one. I'm glad I'm not the only one that's making sometimes those mistakes. So I know also on your website you have sections on there on cryptocurrency. I'm looking mystockmarketbasics.com. So what are your thoughts in general? We talk about crypto on this channel a lot. It's something I'm kind of passionate about. I'm a believer in certain parts of it. Some of it I'm not so much, but particularly Bitcoin. What are your thoughts on the general cryptocurrency market and what's happening at the moment?
Sure. Well, I was a skeptic to start off with. From right around 2017 when it was hitting those peaks, I was skeptical that it had any value, any of that. And then I think, like a lot of people that have actually spent the time to do the research and learn what the blockchain is and how it gives intrinsic value to a lot of these coins. Obviously, not all of them, but a lot of them, like Bitcoin, like Ethereum, like some of the other altcoins. Then I came around to the idea that this is a revolutionary technology, and some of these, some of the larger coins, the more stable ones, do have intrinsic value based on network effects, based on just the proof of work and proof of staking model, and some of these other valuation methods. I invest in Bitcoin, Ethereum, Cardano. I also have Polygon Matic is one I'm really excited about, and I think they have some real upside opportunity. Obviously, as a risk asset, they're running through a tough period right now. And I think investors need to understand what Bitcoin and crypto is and what it isn't. Okay, does it have elements of an inflation hedge? Yeah. Does it have elements of digital gold? So, kind of that gold safety and stability and store of value. Yes, it has elements of that. Does it have elements of a non-correlated asset where it's going to protect your portfolio from a stock market crash and other things? Yes, it is an uncorrelated asset. It has elements of that. But at its heart right now, where it is at in its development, it is a high risk asset, right? So, while it does have elements of an inflation hedge, elements of digital gold, you hear all the naysayers saying, it hasn't lived up to its standard or what it's supposed to be as an inflation hedge or as digital gold. Well, yeah, but that's not what it is. Okay, it is a high risk asset. it's going to be, it's going to sell off when high risk assets sell off, like growth stocks, like tech stocks, like the stock market in general. And that's just how it is right now. So you have to invest in that. Eventually, it will more completely fulfill a lot of these other standards, right? It will be an inflation hedge when Bitcoin reaches that 21 million cap on the coins. When it's used more in trade transfers and things like that, it'll be more of like a digital gold and a store of value and an asset. And it'll eventually be less correlated with stocks and a lot of these high risk stocks eventually. But right now, what it is that high risk asset. So all these articles you see that skeptics and naysayers saying that it hasn't lived up to what it's supposed to be. Well, it's not what it is.
Right. I think one of the main comments that we get about cryptocurrency on this channel certainly is that Bitcoin doesn't really, it's not tangible. They can't see any value in it itself. And I know this is kind of a deep rabbit hole that we don't really want to go too much into, but what would be that one thing you would say to somebody that doesn't really understand Bitcoin and show how it actually does have value? Is it in its future value of what it can become, or is it now intrinsically valued? How is it valued?
Well, there's a couple of different methods you could use. One, and for those saying that it doesn't have value, it doesn't have a tangible value. I mean, all money is subjective, right? It's subjective on the full faith and credit of the issuer, of the United States, or of the sovereign government. A digital Bitcoin is any more or less value or tangible than a digital dollar, which most of our money, most of our dollars are digital right now. They are zeros and ones rather than that dollar bill. So there's really less difference than I think most people think, right? As far as the valuation, I'd say one is there's a very important kind of a law in mathematics called Metcalfe's law that measures the network effect of a network, right? And it's been uncannily useful in valuing stocks where that network is really the prime driver of sales and fundamentals, like social media stocks like Facebook, like Twitter, things like that, where they have that network of users. You can use that to value it. As far as more of an intrinsic value, I would say Ethereum is probably a little bit better example of that, because it does have that that intrinsic locked-in value for DeFi projects, for a lot of the projects built on that blockchain. And the way you build, the way you make a contract on that blockchain or make changes on that blockchain is it has to be verified by by users of that token, right? Or in the proof of work model with the miners, then they the miners verify that those transactions and get compensated in the in the coin, right? In the proof of stake model, they put up their coins as stake for those transactions. So to have those transactions taking place in the blockchain, which are very important, the blockchain is revolutionizing a lot of industries, health, not only technology, but healthcare, finance. A lot of the technology is really useful in these industries. So we need those transactions validated, and the only way to validate those is to use those coins as as either proof of work or proof of stake, right? So that gives it some kind of an intrinsic value in there. Now, granted, that intrinsic value, just the base intrinsic value based on validation, is much lower than the current prices. I mean, there is an element of speculation and investment in the current prices that is over and beyond the intrinsic value. But it's like that. It's like that in all stocks, right? If you take just the pure intrinsic fair value of based on sales, based on earnings of a stock like Tesla, a stock like Netflix or Apple, it is the current stock price is well above that fair value, that intrinsic value. So it's no different from stocks and cryptocurrencies.
Yeah, I love that explanation, Joseph. So I went back onto your YouTube channel. I went to the oldest video because that's what I love to do.
The very oldest
when I look
one.
at people.
Horrible.
Well, you know what the funny thing is? So we are, this financial thing project was really based on peer-to-peer lending, because in the UK that is a very big sector of investing. It's not as big as it used to be because we've had some issues over there. But I'm looking at your very first video, and it was what is peer lending, and that's really interesting to me because that's what this channel really started at. Was that something you invested in back then that you still invest in now? What are your thoughts on the peer-to-peer lending sector?
It was. It was when I actually first started out on my blogs in 2014. Then I started a few blogs, and a lot of it was geared towards P2P lending, not necessarily, not only for on the investing side, but also on the debt side and the consumer loan side. But specifically on the investor side, I was an investor on Prosper as well as Lending Club. Switched over to exclusively Lending Club after a while. Mm-hmm. And loved it. I love that democratization really of of the type of the asset class, because we've had consumer loan securitization for decades, right? That's what banks do. That's what a lot of the credit card companies and that do is they securitize their loan portfolio and then sell it off to the investment banks and things like that and the accredited investors. It has never been accessible though until P2P for regular investors. So it was really exciting. It was a very exciting time there, 2014, 2015, when it was just starting to come up. Unfortunately, as we see so often, regulators got in the way, really put a foot down on the market. I know a lot of states' attorneys generals were really pushing hard on peer-to-peer lending sites, not giving them access to people in that in those states. Myself in Iowa at the time. Then I couldn't connect my bank account. I think it was with Prosper, but Lending Club was open to residents of that state. So it was difficult, and I think that really hurt the growth of a lot of them. And of course, we've seen even Lending Club has gone back to accredited investors only, over the last couple of years. So I don't invest anymore. I mean, I'm an accredited investor. So if I want to invest in consumer loans through securitization, I can do that through, an investment bank or a lot of other sources. My passion for it really was that in that democratization that they were bringing it to Main Street investors. So when they shut that down, it was painful.
Yeah, and I'm not sure if you follow what's going on in other countries when it comes to peer-to-peer lending, but we saw several companies that went into administration in the UK, had a lot of issues. There was some fraudulent companies around in this sector, really took a beating, and it was pretty heavily regulated, but there was some things that really slipped through the cracks and caused a lot of pain to people financially. So it's kind of been a bit of an unfortunate downfall. But it happens, when you have a new sector like that. It's only 2008 was the first one that came out in the peer-to-peer lending world. But I just thought it was interesting that you had that as your first video. So you don't invest in peer-to-peer lending anymore. You've kind of moved on, it sounds like. You're passionate about financial education. I see that on your YouTube channel. You like telling people about your experiences or what you know about that. One thing I've noticed, especially after COVID, and this was probably brewing before that, but YouTubers became these financial experts. There was a lot of people out there telling people what to invest in, maybe purporting to be something that they aren't entirely that experienced as. Sure. And then we've seen the uprise of these websites that have made it very easy for people to invest, maybe more than they should be doing. Like Robinhood has just made investing so accessible. I mean, I don't know if you're my age. I'm in my late 40s. But we didn't have that. It was quite difficult to invest back in the day before all of these websites came and made it so accessible. Do you think that that's been, hurtful in a way to people having such easy access to being able to invest their money, maybe when they don't understand what they're getting themselves into? Or is that a benefit that there's so much education now and so much accessibility?
Sure. Well, I mean, there's a lot there, right? I think I think that the advent of YouTube, TikTokers and YouTubers being financial experts, right, is just kind of the evolution of what we saw in the dot-com bubble, right? The dot-com bubble, it was your cab driver that was giving you investing advice, right? It was the cab drivers pushing pets.com and that kind of thing.
Damn that guy.
Yeah, and that's just the that idea of retail investing advice come to the social media, the social era, right? So everything has come online, everything has gone social now, and those same people, right, that had that next hot stock pick have come online. So I don't know that there's really anything different there other than just the medium in which they're using. Obviously, you always have to consider the source for your investment advice, their experience, and where they're coming from. As far as the other, the other idea here, that the retail brokerage platforms, those have been obviously developing since decades as well. I started from Brown and Company, the platform, in 1999, investing. That got bought out by E-Trade, and really, and back then that $5 per trade was huge. That was revolutionary, right? Because Schwab and Fidelity, a lot of those were still charging $20, $30 a trade. So that really helped, move the industry into a little bit more retail friendly, where people could afford to be able to do that. And then, of course, we saw Robinhood come with the zero, the commission free. And while there have been cons, negative effects of some of their other parts of their business model, where they make it almost like gambling. They make it almost too easy to trade. I won't say necessarily too easy to invest, because I love that people have that option to invest their own money rather than paying some financial advisor a percentage and fees. But they've made it not just too easy to invest, but too easy to trade and to gamble, right? And with their the confetti that falls when you get your free stock and when you buy a stock and things like that. So I do think there have been pros and cons to that. But that kind of democratization and access is never wholly a bad thing.
Yeah, I agree. I think one of the things that I don't like about Robinhood is the fact that it is free to trade, and I think sometimes when there's a fee involved, it makes you think twice about making rash decisions. Because I know when it was $20 or £15 for all our UK people, they would certainly think twice about exiting that position, because it was going to add up.
And that's an interesting idea that maybe we need a platform that doesn't necessarily charge you to trade, so that $20 to trade, but you have to put $20. You take $20 from your account and put it into maybe a retirement account on the platform. So basically, they just shift that money. You still incur some kind of a cost to trading, so you have to make that longer term decision, but it's still your money. It's still commission free. That would be interesting.
Yeah, I just gave you the $1 billion idea for the next trading platform from your phone.
I'm going to be the next
Weeble. You'd be the next Weeble. So let's just talk about financial advisor. I know you're not a financial advisor, you're an analyst. Oh, and if you can just go ahead and hit the thumbs up on the stream right now, so I don't have to nag you. Not you, Joseph. People out there watching, we definitely appreciate it. It helps with the YouTube searching stuff that I don't really understand, but it does. Talk about financial advisors. My first experience with a financial advisor came, this guy, very highly recommended from a very powerful lawyer who is very wealthy, and I thought, wow, he must know what he's doing because he's got all this money. So his financial advisor must know what he's doing. Turned out the guy wasn't very good. Put me in all these managed unit trust mutual funds that performed really badly over 3 or 4 or 5 years. I didn't pay too much attention because I had no idea what I was looking at in my 20s. What are your thoughts on financial advisors now? Do you think that people should be DIY investing now at this stage because there is so much information out there that you can get now? Or do you think there is a place now for financial advisors where people should be using them?
I think there is a market for them. It's I think a much smaller market than it actually is. There are people that just want that personalized feel of somebody doing it for them or somebody guiding them through. I would say there's also for people that want that do it for me or that hands-off stress-free approach, there are robo-advisors that basically do it algorithmically and charge much less. But obviously we are both in the business of financial advice and that kind of thing, and I think for us it just seems so easy just to go on YouTube, get some ideas and learn about investing. For a lot of people, I think it's still kind of intimidating and they just don't want the stress and the hassle. So I think there is a market still for that personal financial advice, those people, but there are a lot of pitfalls and a lot of hurdles. A lot of things you need to watch out for, right? You can always One thing I always say is you always have to check your advisor's background on FINRA, the broker check. So the main regulatory body here in the U.S. That regulates, financial advisors and that kind of thing. They have a site called Broker Check, and it runs, it is a database of the complaints and penalizations against all the brokers. So you can check to make sure your advisor isn't on there in a bad way. You can check, make sure that they are a fiduciary. So make sure that within their business model, they have your best interest in mind, not necessarily their commissions and that kind of thing. And just go for a fee-based advisor rather than someone that's going to make their money on commissions, especially a lot of them. That's going to sell you into those mutual funds and those kind of ideas, because a lot of times they get that kickback from the mutual funds, so they have kind of a vested interest in pushing specific funds rather than maybe the best investment.
Yeah, great answer. And that's why I've always said to people that, generally if you don't know what you're doing, just put it in an index tracker. You could do it yourself. You don't need to worry about it. It's just time tested.
Sure.
Now, I got started with my investment journey quite late in life. I was in my early 40s because I just didn't understand the world of finance and I didn't want to deal with it. What advice, Joseph, would you have for somebody who got started later in life? Maybe they're in their 40s. Maybe they haven't even started now. What advice would you give them to try to get going so they can hit that retirement goal even though they started late?
Sure. Well, as somebody in their 40s themselves, I'd say 40s isn't bad. 40s is not old.
It's not old, though.
But I guess you say that every decade, right? You say, 50s isn't old, and 60s not old. But 40s, as far as investment time horizon, 40 isn't old. You've still got, at least 20 years, most likely, until you're really planning on retiring, or you have to retire. So that's several market cycles, and you've got lots of time to build a portfolio. I would say don't try to play catch up with the risk. A lot of investors, a little bit more so in their 50s and even later, they'll come into the market and they'll say, okay, well, look, I only have maybe $10,000 saved up right now. I need a portfolio of 500,000, a million, what have you, and they'll figure, okay, if I'm going to make that amount, that goal, I need to be 10x my money every year, every 2 years, every 5 years. And so they'll go for the highest risk stuff out there. They'll invest in the smallest of the small penny stocks. They'll invest in the growthiest of the growth stocks. And of course, with that potential return comes the risk. And of course, unfortunately, a lot of times they just end up losing the vast majority of their money. So, if you are getting started later, I would say, in your 50s and even later, then you got to understand that your risk tolerance or your ability to tolerate risk is actually lower. And that might seem counterintuitive. You would think that you need more risk to make more return, but your risk tolerance is actually lower because you don't have the time to build back from a market crash, right? If the market were to crash and you have only 5 years left to retirement, then you don't have time to see stocks rebound, because they always do. But sometimes it takes a while. Sometimes it takes that 5 or 10 years. You don't have that time. So your risk tolerance is actually lower, and you need to invest in maybe a little bit safer stuff, safer stock sectors like the utilities, like consumer staples, things like that. What I would say to make up the difference, though, is one, treat your investments like a savings account, right? Every month, put a little bit more in there, put as much as you can in there, and just keep on, time. They say time in the market rather than timing the market, right? So just keep on investing. Find ways to make more money, whether it's through a small side hustle. You can do something for 5-10 hours a week. Or an online business, anything like that, to make more money to invest. That's going to be your best and most assured way to build that portfolio, rather than going after those riskiest of the risky stocks.
Mm-hmm. Okay. The market right now, I think, is crazy. I'm looking at what's going on in the economy. We got this inflation problem. It's happening in the UK. It's happening in the US. We've got the interest rate problem. We don't know what's happening with the rates. We think they're going to go up, but the Federal Reserve in the US keeps changing its mind. They say one thing, the next week they're saying something else. And it seems to me like there isn't really a safe haven anymore. Bonds are negative yielding. I mean, I've held bond index trackers that have done absolutely nothing or are in the red. I think one of my bond index funds is like down 9%, which is crazy. So it doesn't seem like there's a safe haven right at the moment. And do you think right now we're in a bear market generally in the stock market?
Well, I mean, technically we are.
Right.
Technically, the stocks in the S&P 500, which is that broader market, have hit 20% down. I don't think they've closed there. Maybe today they've closed there. So it would be technically that bear market. Nasdaq stocks in the Nasdaq are down something like 32%. So those are definitely in that technical bear market where it's 20% or more down from the peak. We're not quite in a recession yet, obviously, which is the two consecutive quarters of negative economic growth. We're probably getting there in 2023, just on the pace of Fed rate increases, but we're not quite there yet. So we are definitely in a bear market, a technical bear market. Mm-hmm. Obviously, the question is, will it get worse or will it get better? And so that's the $64 million.
Do you have the crystal ball?
My magic 8-ball isn't. I dropped it and dropped all the fluid out of it. But I do think we're in for like some kind of a relief rally here in the summer. Rates have come up quite a bit and are really stabilized right now. So I don't think you don't quite get the pressure from the rising rates just yet. Pretty much the entire year's worth of Fed rate hikes have been priced into the market right now. So you got a lot of negativity in the market. A lot of consumer sentiment indexes and investor surveys are hitting very, very lows, very much lows. But against that, you've still got a very strong consumer, which is about 70% of the economy. You've still got consumer deposits at savings institutions is up on a year-over-year basis. You got credit spending is up year-over-year. Retail sales just came out this year or this last week, and that's up like 8.3%, I think, year-over-year, which is very strong. So you've still got a very strong economy and a consumer. So I think there's just so much negativity. A lot of it, I think, is management at corporations really kind of playing the expectations game, right? Since everybody else is lowering their guidance, lowering their outlook and expectations for earnings and sales for the next 3 quarters, then everybody's doing it, right? Mm-hmm. Because nobody's getting blamed on it if they do it when everyone is doing it, and so that just allows them to, when the second quarter results, when the third and fourth quarter results do come out, they're able to beat those expectations that they lowered now. So it's really a case of throwing the baby out with the bathwater. Sure, there are problems, there are economic cracks appearing with inflation, higher interest rates, things like that, but not nearly to the extent, I think, as management is making it appear, basically just so they can look better later on in the year. So I do think we get some kind of a relief rally when that becomes evident, when they do come out with those other quarterly earnings and say, hey, look how great a management we were. We beat those expectations so handily. And we did, we saw the first quarter, even though people were saying the rest of the year is going to be so weak, about 79% of companies beat their expectations and sales for the first quarter. So mm-hmm. did very well. It's just the negativity that was weighing on the market so much. And I think that does clear up a little bit over the next, 6 months or so. Further out, though, into 2023, I do think we get a recession with the Fed increasing its interest rates so aggressively, and really nothing to stop them from doing that. Unemployment is still extremely low, and really giving them fair rein to increase interest rates. So I do think, after that relief rally we get this year, then I do think it's time to get a little bit more get a little bit more protected in stocks and even in bonds. Bonds have come down quite a bit over the past 5 months. Really, historically, it's been the worst bond market in decades. But mm-hmm. But they are now, like I said, those rates are stabilizing. So the sell-off in bonds has ended, and they are providing pretty attractive yields right now. A lot of the bond funds are now back up to 2 and 3 and even higher % dividend yields. Yeah,
and even in our UK friends don't have this, unfortunately, but here in the US, the US government offers these different bonds, like I bonds, TIPS, that are paying some crazy, I think I saw 9% government
Yeah.
bonds at the moment.
The Series I savings bond is 9.6%.
That's
Great
crazy.
opportunity. You're limited to $10,000 in it. You can get one for you, your family, every member of your family. You can actually invest in them through a corporation, a small business that you own. So you are capped, but you can extend that cap a little bit, and it's a great return. Yeah,
Yeah,
9.6%.
it's unbelievable. One of our esteemed watchers here, Mike, made a really interesting comment. He said he thinks one of the more interesting sides of the stock trading sites that offer free trades is the fact that you can take fractional shares. And, if you're somebody who has a smaller trading account balance, you can spread that around a lot easier now. That was something that didn't exist in the past. So that's a pretty cool feature of something like Robinhood.
Yeah, Robinhood, M1, a lot of those. I know a lot of those they allow that, and it makes automated investing so much easier too, because you can invest whatever you invest each month, and then the site can break it down into exact portfolio percentages, however you have your portfolio set up, regardless of the share price and things like that. So there have been a lot of benefits, even with some of the cons to those sites.
Yeah, and I absolutely, Joseph, this is one thing that I really think is so important for people investing out there. Automating your investing, I think, is probably the single most important and powerful investing tool that we can use, because I know when I was younger, I used to, if it was left to me, I wouldn't remember to do it because it wasn't high on my importance list. I hated investing, and once I set it up to come out of my account every month automatically, I didn't have to think about it. I think that's really what changed my investing mentality, because I could see that balance starting to grow. Whereas before I thought, if I put $100 in, it's not going to make any difference, right? If I'm getting 3-5% a year. Once you just do it on an automated path, I think that's absolutely critical. Joseph, let me ask you, I'm going to put you on the spot. If you had to pick one single investment to make to start out with, so you had some money, you're like, man, I'm just going to pick one stock or one investment vehicle, what would it be? What would be your number one choice right now?
Oh, wow. Yeah, that is tough, just picking just one, because
Just one.
Obviously you always hate to have that kind of a concentrated kind of portfolio of one stock. So I would say that there's quite a few of the growth stocks, but I do like SoFi Technologies. It's one of the growth stocks that has fallen quite a bit over the last year. I just started investing in these this January and February, when they had come down quite a bit, because it was undeniable last year that the valuations on these things were just ridiculous, ridiculously high. I generally won't pay anything more than 10 times on a price to sales basis, even for a very fast growing growth stock. So over the last couple of years, really haven't been able to invest in a lot of these, but now this year they've come down so much that a lot of these are attractive valuations, and they are still growth companies. It's what investors forget. They see the losses on these stocks, and they think, well, they're no longer a growth stock. They're no longer going to produce those double-digit returns that they did over the last few years. And that might be over the last year. They have fallen out of that growth stock status, but they are still growth companies. They are still changing the world in which we live. And over the next 10 years, that stock is going to be multiples higher. I always make the example of Amazon, right? IPO'd in '97, fell down to from something like $200 a share, $100 a share, down to less than $6 a share in 2001, right? But it was still obviously a very a revolutionary company, and to think with shares up around $2,500, $3,000 last year, to think you could get that at $6 a share in 2001 is just amazing. Something like 50,000% return. So you really do need to watch these growth stocks still, understand and find the ones that are revolutionizing their industry. I think SoFi Technologies is one of those. It's one of the few fintech companies that actually has a banking license. So that opens up a lot of profit drivers for them. Not only can they do a lot of the loans that a lot of other fintech online, those online digital finance companies can do, but they have access. They can provide savings and checkings accounts to their customers. They have access to lower rates because of that banking license that they have. So it gives them a real competitive advantage in an industry that is growing and revolutionizing the way we manage our money. So I definitely think that's one of them that I would be watching.
And they're on sale today, down 8%.
Yeah,
So
they've been on sale for the last couple of months. Yeah, and that's one thing, investors have to understand, have to remember that these are, well, like cryptocurrency we talked about earlier. These are risk assets, high risk assets. It doesn't matter how good the company is, how strong they are, or how fast their sales growth is. If the market continues to sell off like this, they will continue to sell off as well. So that doesn't change the long-term picture and the long-term upside for the stock. So you just have to be ready to take that pain, that short-term pain, and know that that company is where it needs to be and will be there someday.
you got to sit there and hang on, and unless you see anything really alarming, just think of it as a longer-term investment. And a lot of people have doing. Let me ask you too.
Sure.
What do you think about the oil sector right now? This is something I've been kind of heavily investing in the last couple of years when oil was at $40 a barrel, and some people that I'm close to have said, I think it's too dangerous right now because some of these oil stocks have really made big runs. What do you think about the oil market at the moment for investing purposes?
Well, it's obviously been one of the few safety sectors out there, right? One of the few sectors to post positive returns this year. It's actually up like 43% this year. That sector, the energy sector, so the XLE fund. And while I do believe oil is overpriced right now, any kind of negotiated settlement in Ukraine or anything like that will bring oil down. The thing you have to remember, though, for a lot of these companies, well, two things. One is that their cost of production, especially the larger integrated producers like Exxon, like BP, like Chevron, their cost of production is right around $40-50 a barrel. So even if oil does come down to $85-90 a barrel, then they are still cash machines, right? And they're still going to be buying up their own stock. They're still going to be growing those dividends. So there is still going to be a very good cash flow investment. Second is that what we've seen over the last couple of years, as oil prices have come back up, is a lot more spending discipline by these companies than we've seen in the past. Usually, we see oil prices go up, and a lot of these companies, they just increase their production, right? They find more fields, they start pumping more, and of course, that increases supply and drives down the price of oil. They're not doing that over the last year or so. They are having some real spending discipline. They're looking further out, 5-10 years from now when fossil fuels have gone the way of the dinosaurs, right? And they aren't spending quite as much on their capital expenditures. So it's just making them even more of cash machines right now.
Yeah.
So I definitely, I own quite a few oil stocks. Chevron is probably my favorite, but as well as Devon Energy, FANG, Diamondback Energy was ticker FANG, are all good plays.
Oh, I like that. You're making me feel better about this massive risk I've been taking in the oil sector. But so I'm kind of a bogglehead at heart. I always thought about this allocation of my age in bonds and the rest in equities. And there's been some talk recently over the last, I would say 2 years, that maybe that argument is kind of dead because of how poorly the bond market has performed. What do you think about this allocation of your age in bonds for, the safer investment? Do you think that's still a valid investment way to go strategy?
Sure. Well, I think just the 100 rule or the 110 rule, right, which would put you right around quite a bit in bonds. I think it over allocates to bonds. I do think everybody needs some kind of a bond exposure in their portfolio, but I think that significantly over allocates to bonds, and simply for the fact that it's only a 2-asset portfolio, right? You're not thinking other assets like real estate, like maybe savings bonds or some of the safer assets, securitized loans, other things like that. So I think once you include these other assets, I think you can bring that allocation to bonds down because you've got uncorrelated assets in some of these other things. I do think last year I actually sold off a lot of my bonds. Watching inflation rise last year, I sold off a lot of my bonds and repositioned that some of the safety sectors, some savings bonds, things like that, a little bit safer, a little bit less interest rate sensitive on those. But now, I mean, as I said, I think right now bonds are coming back in favor. Interest rates have stabilized somewhat on the long end of the curve, and those they're providing some, once again, the safety and the yield that they used to. I don't think it's, obviously we've left the 30-year bull market in bonds that we were in, so I don't think you can quite expect the 5-6% annualized return out of bonds that you could over the last 30 years. But I think they can still provide a stable 3 to 4% yield, as well as the safety from a stock market crash. So I think maybe 10, 15, even as much as 20% in bonds for people relying on their income. For retirees, maybe a little bit higher, even 25, 30% in bonds, as long as you have some of those other assets to protect you from a stock market crash as well.
Are you familiar with the premium bonds? Have you heard of those before in the UK?
No, I haven't.
So the UK government, they have this thing called NSI, and what they did is they gave a tax-free break, and you invested this amount of money, and it's kind of like a lottery. So they would pull numbers every, I don't know how often they do it, but you would get a letter in the post saying you've won £25, which is $30 or £100. And they end up I calculated a return on these things to be about 1% tax-free. But the older generation, especially my mother who's in her 80s, loves these things because of that little gift they get in the mail. But the returns are so poor on them. It's crazy.
And I think it's the Robinhoodization of bonds, maybe, right? Whereas Robinhood did so well on that making investing fun, the gambling, the excitement of getting a free stock or seeing the confetti fall when you buy a stock. It sounds like a lot like that, right? You're buying a bond with some kind of a guaranteed return, but you're also getting that upside lottery ticket potential.
Yes.
And I think people love that. People really do like that kind of idea.
And there is the opportunity of hitting the jackpot, which I think that they give away $1 million prizes. But these premium bonds have been around for decades. This isn't even a new thing. It's crazy. I just wondered if you'd have heard of that. They don't have anything like that in the US. Let's talk a little bit about your YouTube channel, Joseph. And I saw your first video was about, 7 years ago you've been doing this for? Is that right?
It's been a while. I started the blogs. I come from a venture capital analyst background, so I worked with venture capital firms, set up sell-side research departments for them, as well as just traditional equity analysis for some of the larger bulge bracket banks on Wall Street. In 2014, I started my own blogs. Really wanted to get away from the 1%, the private wealth management kind of idea, and get back to Main Street investors. So I started the blogs, started the YouTube channel really just to host videos to put on the blogs. I really didn't do anything with the YouTube channel until 2017, and then I actually did start creating videos just for the channel and trying to grow the community there. And it's been amazing. I really love the sense of face-to-face community you get with YouTube there. So since 2017, it's grown from, I think I had 1,700 subscribers in 2017. It's now about 550,000. Great sense of community and great back and forth we get from everyone there in the nation. Yeah,
it seems like you're putting out videos. What about 3 or 4 times a week? So you've been busy over there.
Oh yeah, I do. Try doing a live stream every Monday morning at 9 a.m. Eastern, trying to kind of what to watch for the market, stocks to highlight the week, that kind of thing. And then I'll do videos Tuesday, Wednesday, and Friday on the week as well.
Yeah, so go subscribe to Joseph's channel, everybody out there. It's called Let's Talk Money. There's a link in the description. Go show him some love. And then last but not least, tell me about your mystockmarketbasics.com.
Sure.
Is a blog that you have. What's that all about? Tell me about that.
Sure. Well, really just just the blogging side of the YouTube channel, right? Talking about really the basics of stock market investing, getting people started right, getting people started where they're not constantly trying to pick stocks or time the market, that kind of thing. Really getting people back to those basics, the timeless basics of investing that really actually make you money. So yeah, try to put out a couple articles each week on there, and just kind of grow the community there as well.
Is this something you're doing on your own, or is this something you have help with? Because I know I found it like really difficult trying to juggle myself, the YouTube, the blog, doing the live streams, because live streams, you got to do all the research. It takes time to figure out. Is this something you work on your own? Do you have people helping you?
I mean, it's a full-time job. I'm 55, 60 hours a week working, but I do have, I've got an editor, I've got an assistant that does a lot of the administrative stuff. I do all my own research and content and writing and that kind of thing, and analysis, of course. But I got a team behind me to help with the administrative stuff.
Yeah, it's probably something I need. This hair just keeps on getting grayer from all the workload. I mean, I think we've had a really good chat. We've been going for about an hour, and I mean, really good feedback. I hope that everybody will come and subscribe to your channel and show you some love, because our community is cool. They tend to show love. But we got people tuning in right now from Europe and the UK, Greece, and they're telling me that these premium bonds, what we're talking about, are going up to 1.4% returns. In June.
It's a lot. It's 1.4. Can't beat that. Can't beat that when the market's falling 20%.
Oh, it's so tough, isn't it? Because you're like trying to beat this inflation somehow, some way. I mean, it's crazy, right? 9% inflation. You're getting 1% in savings accounts now, if you're lucky, maybe 1.2%. And everybody's trying to find, like, what the hell are they going to do? And how long is this inflation going to last for? How do they find places to invest where they're not taking on scary amounts of risk? Because I do, sometimes, Joseph, when I look at my trading account, I feel like I'm taking way too much risk, and it's scary. And when I saw this oil stock price retraction happen, I think it was last week or maybe a couple of weeks ago, when everything really dipped, it kind of gave me that sick feeling in my stomach, where I didn't have that when I just invested in index funds. I didn't worry about it. I just left it alone. But you don't get the same kind of upside. It's crazy.
No, of course not. Well, what I think it's important that everybody has a portion of their portfolio, and probably a large portion in the index funds. I always use the core satellite strategy, right, which is where you have maybe 50-60% of your money, even more, in just those core index funds or ETFs that you like. 5-6 ETFs gives you that broad market return in different asset classes. And then you could take that other 40% of your money and invest in individual stocks, maybe even 10% of it, and do some trading, things like that. Mm-hmm. So that's going to get you those long-term market returns. You're going to enjoy that kind of risk premium, but you also get to satisfy that itch of picking individual stocks, even trading in and out of stocks if you like doing that, and a little bit of upside potential if you're right on picking those stocks. But if you're wrong, or if you make some bad decisions in that 25, 30, 40% of your portfolio, it's not going to destroy your wealth, because you do have this market return from the majority part of your portfolio. Yeah. So it's a great way to kind of balance the two ideas.
Just stay away from Intellia Therapeutics, by the way, everybody out there, because that one's been a disaster. Somebody has a question for you, Joe. This is Darren. He's in Cambridge, the home of the university. Have you ever been to the UK?
No, I haven't.
What?
Joseph. Yep. I haven't been
Joseph.
I did a med float in the Marine Corps, so I got to see a lot of the Mediterranean there. Corfu, Greece, Sigonella, Sicily. They're in Spain, a couple of ports, so that was great, but never further north.
You've got to go across the pond, Joseph. The question for you is, I see on the shelf behind you a copy of The Intelligent Investor. What's the other book next to it?
Quite a few books there, actually. Let me see. Columbia History and Diploma. Well, on that, right next to there, that would be the Columbia History of the World. Big history buff. Love really reading kind of the story of mankind, right? Best story ever written. Better than anything Hollywood's ever produced, right? So I'm big history buff. Then the other one is Henry Kissinger's Diplomacy, which is another great book. Really long. It takes you a while to get through, but it's a great view of diplomacy through the last 500 years, really.
Yeah, great question, Darren. Thank you. Hey, if there's one book that you could recommend, Joseph, that somebody to read about investing, what would be that one book? What's your favorite book?
One book, and I guess with deference to Graham there and the Intelligent Investor, which is also a good book. I would have to say One Up on Wall Street by Peter Lynch. Great book for a little bit more a little bit more Main Street investing ideas. I think it's better written. And more easily accessible as far as translating it into actual investing ideas.
Okay. So do you think we're going to have the big one, this big crash that everybody's been kind of worried about because of all these factors that are going on in the world globally with the economic situation? Do you think there is going to be a big one?
Well, the market's already down 20%. So if you just look at history, if most stock market crashes that have not been followed by a recession have been between 20 and 30%, which would be right about where we are now. I do believe we are going to get a recession here next year. So though the ones that have been followed by a recession have been, between 30 and 50%. So we probably are in for, another maybe 20%, 30% lower. What I always say is, you need a formalized strategy for when and how you're going to invest. Otherwise, you're watching the market daily, you're trying to time the market, and you're just stressing out, completely freaking out about, is this the bottom? Should I invest now? So what you need to do is set markers on an index fund. You're not necessarily investing in that index or anything, but you're just using that as a marker. Right now, the S&P right around 3,900. So if you set, 3,500, 3,000, and 2,500, right? That would be around 27%, 37%, and 48% down from the peak at those 3 points, right? So at those 3 points, you just say, you know what, if the market gets down to that, then I'm investing a third of my cash. And you can pick individual stocks or however you want to do that. If it gets down to the second marker, I'm going to invest the other third of my cash, right? And then the third one, I'll invest all my cash. I'll be all in, if the market hits that 48% down at that point, right? And what this does is, one, it gets you invested, so you're taking advantage of lower prices now just in case they do rebound, but it also keeps some cash aside for if the market does get worse, to be able to take advantage of those prices. It keeps you from second guessing. It keeps you from stressing out over trying to pick a bottom in the market. So it's very, very much a stress-free or a less stress kind of way to time the market, right? And it's going to give you those opportunities to really take advantage of prices as they come along.
Yeah, that's great advice. I remember when the dip happened in March 2020, and I was thinking, I'd been waiting for a dip for I think 5 years, and then when I saw it come, I thought, oh, it's going to go lower. It's going to go lower, and then I missed it, and I ended up going back in at a much higher rate than I would have done if I'd have had that strategy in place that you're talking about.
Well, and that's the problem. People. Hindsight's 2020. You never know how bad it could get. 2020, we were looking at a global pandemic that could have just completely shut off the world for years. It could have been much worse than it was. So even 35% at the bottom, who knew how bad it could get? And I think, a lot of people without some kind of a formalized strategy like that, yeah, they do sit out. They sit out for way too long. And that happens every crash. It happens in 2008, 2000. People sit out for way too long and miss a lot of the upside.
Yeah.
So you really do need, set markers, dispassionate analysis to be able to get in and put some of your money to work at least.
Great advice from a sage, wise man in Colombia, Medellin, Colombia. Joseph, is there anything else you want to tell the people out there who are watching now or in the future about what you're up to, or anything that you want to push?
No, I just, again, love to see everybody there on the channel. Let's Talk Money. Love seeing everybody there in the community and be able to have that kind of face-to-face.
Okay, awesome. Well, listen, I hope one day in the future we'll come back and have another chat and see how things are going in your life. Maybe I'll run into you in Florida here, so we'll kind of be neighbors. And it's been a really enlightening chat, and thank you for sharing your wisdom and knowledge to everybody out there. Appreciate you, Joseph.
Absolutely. It's a pleasure.
Okay, we'll catch you next time, all right? Thanks. Okay. So there you have it, Joseph Hogue. Please go check out his YouTube channels. Throw him a subscribe on there if you will. I think that's just awesome what he has shared with us. I love to get into that. I did completely got the CFA wrong because I thought CFA was a financial advisor. Shows what I know. But yeah, go subscribe to his channel. Go check out his website. Show him some love. We'll be back on Thursday at 7:30 p.m. UK time with Philip. and he is the CEO, co-founder of Landlord Invest, the UK peer-to-peer lending company. We're going to have a chat. Bring your questions, bring your comments, bring yourself. We'll see you then. Thanks, everybody. Love you all. Thanks for being here. Talk to you soon. Take care. Have a great Tuesday evening. Go get some tea and biscuits. All right. We'll see you soon. Bye.